Okay, so we got one from Suzanne here, and it says, for planning purposes, how do I calculate the future value of a SPIA? I want to estimate the impact of my combined deferred accounts, RMD, for my 5-year plan. Can you give an example of the calculation?
Okay, this question is actually a cousin to another question on our list that actually explained the problem correctly, but then asked us if their explanation was correct. So maybe we should read that other question and then come back to this question because it lays more of the situation of what's going on. I could read the question.
Okay.
So this question's about something in Secure Act 2.0, which is beneficial for owners of SPIAs in IRAs. So let me read this other question. It'll provide more context. Then we'll come back to this question too. Okay, could you say something about the new RMD rules for people who own a qualified annuity that has been annuitized and also own a traditional IRA that is subject to an RMD requirement? I understand that new IRS rules finalized this past summer allow annuitants to aggregate the December 31st account value of the annuitized annuity with the December 31st account value of the IRA for the purposes of determining the combined annuity and IRA RMD requirement, dollar for dollar. And because the annuity payout on the annuity account balance will frequently exceed the RMD amount that would be required on the same balance under the IRS tables, you will end up with a lower aggregate RMD if you aggregate the annuity balance together with the IRA balance for the purposes of determining the total RMD, instead of using the alternative method of applying the annuity distributions to satisfy the RMD requirement and separately using IRA distributions to satisfy the IRA RMD requirement.
Okay.
Do I understand all this correctly? And are there any pitfalls? So first,
for those,
yeah, I'll try to re-explain.
like myself, I think what the question ultimately is, hey, we can now combine accounts that have an annuity in them, like an IRA account with an annuity in them. We can combine that account value with another one, with another IRA, and have a combined RMD together, as opposed to taking RMDs independently from those two different accounts.
No, because it's about SPIAs. I can explain more context. Okay, Secure Act. So first of all, if you were able to follow, I didn't read that very well, but yes, what I read was correct. So that answers the first part of the question. What was that saying? So Secure Act 2.0 added a nice provision for individuals that own SPIAs in IRAs. To clarify why it's a nice provision, in the old days, suppose, let's say, I've got $500,000 in my IRA. I take half of that. Maybe I'm making up weird numbers, but I'll take half of that and put that in a SPIA. The SPIA will provide me monthly payments for the rest of my life. It's very likely the case that the SPIA payment would be higher than the RMD would have been on that $250,000 I just put into the SPIA. In the old days, this was bad because I couldn't count any of that SPIA payment against the RMDs due on the other $250,000 left in the account. So I ended up having to take out more. I had to get my SPIA payment. That covered the RMD just for the SPIA premium. And then I still had to take my RMDs on the remaining IRA assets. The new rule with Secure Act 2.0, and that's what was being described in this paragraph, is every year there'll be a calculation done that on the present value of your remaining SPIA payments. And then you calculate the RMD on that present value, and it's probably going to be less than your SPIA payment. But you take the RMD on the present value of the remaining annuity payments plus the RMD on your other IRA assets, and that's your total RMD due. But now you can apply the excess SPIA payments against the RMDs due on the non-annuity assets as well. So it lowers the amount you're required to take out of your IRA. It's a very nice provision. So with that first question, yes, that individual stated it correctly. They also asked, are there any pitfalls to be aware of before using this method? And the answer is no, not really. Every year, the annuity insurance company will have to send you a form telling you what this number is, what this present value is, to be able to then know what the RMD on it will be.
So
now the other question is understood all this and is now getting to the question of, okay, well, how do I know what the present value of my SPIA payments is so that I can estimate what those RMDs will be over the next 5 years? That one, it's a present value calculation. You consider over your remaining life expectancy, well, how much are you expected to receive from the SPIA? And then looking at current interest rates, what's the present value of that amount? That's going to be what the SPIA is, its present value. That's what the insurance company is going to be doing. If you really want to get precise about it, you can find the IRS rules about how to do those present value calculations. They have their life tables showing you how many years are you expected to receive this SPIA payment. And then based on the interest rates that you use, you get that present value. Now, that being said, if you want just a back of the envelope type calculation so that you can get an idea about this, you could, this isn't going to be correct, but it is again, as a 80% of the way to the answer. Just before you started receiving SPIA payments, just assume the RMD, I mean, the SPIA value was the premium you put into it. And then each year, subtract what those SPIA payments you received are. So if at a $300,000 premium into the SPIA, initially you can calculate the RMD off of $300,000. In the first year, I get $40,000 of payments from the SPIA. So subtract that from, now I have $260,000. As a rough estimate, I could treat the present value of remaining SPIA payments as that. The next year, subtract the next $40,000 I receive, $220,000 left. That's a rough estimate that will give you some idea about this. The present value is never going to be higher than the premium you paid, well, unless interest rates dramatically change, but you can probably set that aside to the most part. And that's going to give you a rough estimate. Beyond that, yeah, the IRS does have information about based on the interest rates and giving you the life tables based on how many years you receive the SPIA payment. You could use Excel to calculate the present value of those SPIA payments. And then that would be an estimate that you use to calculate the RMD.
now wait, when I want to make sure I got it right myself. When I was listening to the question, I was specifically answering the first part, not how to calculate the present value of a SPIA or anything like that. And isn't the new law effectively like, isn't that what you just, did I get it wrong? Because you're combining both accounts to then, get an
Well, you're
RMD.
talking about aggregate. Yeah, technically you are aggregating. Well, it might be in the same IRA.
Yeah, okay. Sure, they're in the
But
same area. But if you have
it's
two,
not
one of
about
them
the
is just
general.
annuity and one of them is like a regular investment account, you can aggregate those. And that's all I
Oh
was.
yeah, you can aggregate different
Yeah,
IRAs and
that's all I was
calculate the
getting at
RMD.
with mine.
Yeah,
Okay.
that's a correct statement, but it just doesn't have anything to do with this question.
No,
I mean,
I
it does at the extreme, but that's
it,
not the main thrust of.
no. The main thrust was the value, and I get that. Now don't. I was kind of like on ramping. Don't you need? Does the insurance help you? Does the insurance company help you at all with the value itself, like year-end statement or something like that?
Yeah, they'll need to send you a form that will tell you what the present value of your SPIA is so that you can calculate its RMD.
Okay.
If they don't, there are guidelines about how to do those calculations, but I can't give the exact explanation for
No, that's fine. That's fine.
that on a podcast.
Okay, let's do the next one. My husband's 403B plan miscalculated our automatic RMD withdrawals for the past 5 years. Who do you think is responsible for fixing this?
Okay, that's ultimately something you may want to speak with a lawyer about. I'm assuming the problem is they undercalculated, and so now the IRS wants to apply a penalty for not taking out the full RMD amounts.
And the penalty goes to everything if I'm correct, right?
It accumulates with interest at a pretty steep rate, but the Secure Act did reduce the penalties. Used to be extreme, like even 50% penalties on the amount you didn't distribute, it is the case that, and this would qualify at least as a valid excuse, that I think you could get the penalty down to 10% at this point. But I think the argument here is, well, you don't feel like you should pay the 10% penalty. Your plan sponsor should pay the 10% penalty. And that one, that's really going to be a legal type argument.
Yeah, I mean, there are plenty of ERISA lawyers that would be able to deal with that specifically. But yeah, it seems there's an error somewhere along the path. There could be many variables. I don't know if it's an input error, an output error, or what have you. But yeah, that's for another legal. That's for a legal podcast. I would imagine at this point.
If the mistake went the other way and they just had you take out more than you needed to, there's probably not going to be much recourse for that. I mean, unfortunately, you could have had more tax deferral, but I don't know how that anything could be resolved. It's more the issue of if they told you you could take out less than was required,
Okay.
then there's penalties involved. And you might also take it up with the IRS about not having those penalties applied due to a mistake that was not really your fault.
Yeah, I mean, the only thing I would add to that is, Maureen, look, I feel for you in those situations. We've had many, new clients come to us because of things like this, and unwinding that or fixing that is some of the things, kind of get involved in, and it's never pleasant. So I do feel for you in that regard, but I don't know if we can point a finger at one way or the other, not because we don't want to, it's just we don't. It's beyond the purview of this podcast, other than to call an ERISA attorney and lay down the case and see what they say.
Mm-hmm.
All right. We've got one. Retiring at 50. What contracts or market assets can protect my late life income floor against decade-long inflation of 10% and negative real market returns, i.e. stagflation, Japan?
Yeah, so this is
devil.
this is usually where tips enter the conversation now.
Yeah.
Treasury inflation protected securities provide you an inflation adjusted rate of return. It's currently for longer maturities in the ballpark of 2% real plus inflation on top of that. That would protect, if you bought a 30-year TIPS, that would give you inflation adjusted purchasing protection for the next 30 years. So if you're retiring at 50, that would get you to 80. So the question is more about, I think with late life income floor, you don't have anything beyond age 80. There's no way to get protection against long-term inflation that goes beyond the end of the yield curve, which would be 30 years. You can't get protection beyond 30 years. You can hope that 30 years from now you could roll that money into a new TIPS, but who knows what that would look like in 30 years. I think ultimately, though, it's just speaking to the need to be flexibility, because there's nothing that's truly going to protect against every contingency over a long time horizon.
And this, they continued this question, or maybe they thought of other things. Just this changes the answer here. They also, I'm considering buying TIPS today at a payout at age 80. Then buying a SPIA with 2% COLA adjustments, but that seems a very expensive approach that doesn't really protect against high inflation after age 80. Also, the TIPS plus SPIA approach foregoes 30 plus years of market returns. For example, is there any sort of variable annuity available with COLA adjustment? Just before you chime in, Wade, while you're thinking about the answer here. And so this is where I would also ask, just in terms of the linearity of your thought and making sure that it's consistent. Not that it's not, but this is a very emotional thing, and I want to be able to parcel out everything here. And so the statement started with, I need to protect my late life income floor against a decade-long inflation of 10%. A decade-long inflation of 10%. I assume you mean yearly, not just from one year 1 to year 10, it's
annual.
increased 10%. So right off the bat, it's, I mean, This is the last thing you're going to be thinking about if this happens is like the distribution. I think there's going to be a lot of issues going on with the country if you're talking about 10% inflation. And then in addition to that, you're saying you want to protect against negative real market returns, right? And so it's hard to juxtapose that statement with then the last statement being, but I may miss out on market return. I may miss out on market returns if I invest in TIPS and a SPIA, which I don't disagree with that statement. It's just you can't have it both ways is just the issue I just want to point out. And I'm not being prescriptive. I'm just kind of my observations from the questions. As that we're doing these, the questions actually are quite insightful from the standpoint of how the thinking works for this particular person, right? And so obviously that first statement is, I am scared. Maybe it's, we're just coming off an election. So, and maybe you're on the other side of things and it's like, oh my goodness. And it would have been the same way if the Democrats won. I'm sure we would have had Republicans coming in and this and that. So it's, and I'm not even saying that's you, but that happens a lot right now. And so I would temper that with just, a decade-long inflation of 10% and then negative real returns on top of that. We're going to have significantly greater problems going on if that happens. But that being the case, you took Wade's advice ahead of him saying, okay, I consider, well, not Wade's advice, so this isn't advice, but just Wade's point about considering buying TIPS at a payout rate, then a SPIA with 2% COLA adjustment, et cetera. But that seems very expensive. And then it ends with also the TIPS plus SPIA approach forgoes 30 plus years of market returns. Yeah. So then is there a sort of variable annuity available with COLA adjustments? So I'm just addressing the thinking in that question seems to meander a little bit. Wade, now for the specific answer.
Yeah. Well, so a SPIA with 2% cost of living adjustments doesn't protect you against inflation. Exactly. It's giving you an annual step up of 2%. But if you're worried about high inflation,
10%, you're missing 8.
That's not helping. Now, if you're talking about like having the TIPS for 30 years and then at 80, purchasing something else, who knows what kind of financial products we'll have at that point. It could be a completely different world by then. Maybe there will be inflation-adjusted SPIAs. They've existed in the past, true CPI indexed SPIAs. The last one left the market in January 2020, and no one's been back in the market since then.
I mean, let's just forget the assumptions and just treat it as is. What about the strategy? I'm more inclined to think about it like TIPS. I get, okay, inflation protection, and I'm worried about inflation. Forget the numbers that were put out there, just in general. I'm worried about inflation and the like. I like the TIPS. I would probably forego the SPIA. And since this is long term, because you're thinking at age 80, so I'm thinking 80-ish is the time frame they're thinking about like locking down. I'm thinking a QLAC instead of a SPIA.
Yeah, I mean a QLAC inside of the IRA, you lock that in now. So that's the other option. You purchase a deeply deferred income annuity today,
and then you can make that worthwhile.
But then you miss out on any sort of inflation protection for that. Because if there's this high inflation in the next 30 years, you locked in today.
They lock it down. Okay, they're talking about 80. Maybe when they turn 60 or 65. When they turn 65, they consider the QLAC.
Mm-hmm. And there are, we may see financial innovations. There is already, and I don't know if we can really say the names of companies in this context, but there's a provider out there who has, it's not truly an inflation-adjusted annuity because it would stop payments at age 100, and it's not fully guaranteed through age 100.
You can mention that name. We're going to do a podcast on it as well, and we did a study on it, and I think they can't talk about it. I think we can.
You say it then. You're the compliance officer.
Stonebridge. No. There are some ETF companies that are coming out with interesting solutions. Not ETF companies. There are some investment companies that are offering ETFs with some pretty interesting solutions that have to do with structured outcomes from the income standpoint that are taking, I would say, some interesting qualities from annuities and marrying that with interesting qualities with markets to create more structured products, but that are more liquid in nature and ETF driven. And I'm not saying that's the company to get, but I think it's Wade's point is innovation is really coming in, is going to start to come in fast and heavy within these products, because everyone knows that it's peak 65. All these folks and all these investment companies are looking in a mirror thinking, all right, we've done a great job over the last 25 years with accumulation products, and we'll continue to do so because there's people born every day. But we need to really start focusing on decumulation products, because there's a real gap there. Even from a business standpoint, there's a gap in the offering. And so you're seeing a lot of stuff coming in through there.
Yeah, and so that is that LifeX, it does have that inflation adjusted version. I don't think it's available at age 50. I'd have to double check. There's a age band. I have to double check, but I'm thinking like 55 to 75 is when
I forget.
you're able to.
They just changed some things up to be in an ETF structure as opposed to a mutual fund structure, and I don't remember.
But yeah, we'll have a podcast about that at some point, because it is a financial innovation that speaks to this question. Because the other part of the question, for example, is there any sort of variable annuity available with a COLA adjustment? But again, it's not. If you're worried about high inflation, COLA
or if you're worried about low market return, then who cares about a variable annuity to some extent?
Well, and also, that too, but also just COLA adjustments don't provide inflation protection. They provide a fixed annual cost of living adjustment, regardless of whether inflation is 1% or 20%. So if there's high inflation, yes, you'll get a little bit more purchasing power, but it's not, that's baked into the pricing. You start with a lower payout because it's going to step up over time. You really want some sort of CPI protection. And I'm not aware of any variable annuity that had a CPI adjusted benefit attached to it.
It'd be too expensive, because how are they going to protect themselves from that risk?
Yeah, especially when they allow individuals to invest as they wish in the sub-accounts.
Well, that goes back to another point. This is now a little nerdiness here, but variable annuities may not be the right chassis for you as well. It could be more along the lines of a RILA. Could be a better
variable annuity.
Yeah, if you're using this kind of thinking, then maybe a registered index linked annuity, a RILA would be kind of a preferred choice perhaps than a variable annuity. You're seeing them less and less popular because of the inefficiencies and structural stuff that Wade mentioned within the variable annuity world. Okay.
There was another live question there and this one I think can be a shorter answer because it is an easier question. Finally, a nice, easy question. After full retirement age, to optimize Social Security monthly retirement payments that I'm already drawing, can I just voluntarily pause until age 70? Yes. After full retirement age, you're allowed to suspend your benefit. If you had claimed earlier and then realize in hindsight you wish you hadn't done that, you can pause after full retirement age and then begin collecting delayed retirement credits to offset some of that loss. So if you claimed at 62 and then you pause at full retirement age and then you delay until 70, and suppose your full retirement age is 67, you'd get a 24% boost on that lower benefit you're getting from having claimed early that may offset and get you closer to where the full retirement age benefit would have been. So yes, suspending at full retirement age is allowed. You'll begin collecting delayed credits on that lower benefit amount that you have because you claimed early, but that can help offset some of those lower benefits for you.
All righty. And then you have any questions for me, Wade? Just since we had the write-ins, we can, or do you want to?
Yeah, I think from our big question list, we're ready to start question number 3 from that at this point.
Okay.
Is that, yeah. So Alex. And I combined 2 questions here together that are variations on a theme, but I think they can just be addressed together. So the first question, should I lump sum a Roth IRA in January or dollar cost average throughout the year? And so to be clear, this is when I'm adding new contributions, should I make my full Roth IRA contribution in January or spread it throughout the year? Second question. Now I'm taking distributions. So when it comes to receiving distributions from a tax deferred account, Is there an optimal approach? Is it better to take the annual distribution as a lump sum in January or in December, or spread it out monthly, dollar cost averaging it out? What are the tax implications? Or is this simply based on an individual's needs and personal circumstance?
It's an interesting question. It's good. You know what it's showing me? That the question we would get asked all the time, and we're getting asked this question with more and more, but it's a similar type of question, is I have money to invest in the market. Do I put it all in at once, or do I dollar cost average into the market? Right? And this is kind of the inverse of that, but theoretically it's kind of asking the same thing. Right? Like, do it all out? Well, do I take my money out all at once, or do I dollar cost average out of it? Although you're not dollar cost averaging, or do I take it out on a monthly basis proportionally? I I think I'll answer it. There's two perspectives I want to share, and that if you take it out monthly as opposed to all at once, and the markets go up, I think it was like 0.8 a month, 0.8% a month, or something like that. Whatever adds up to like 10% a year, right? And so if the markets go up over the long term, and you're going to be taking distributions for, let's say, 25 years, assuming you're a total return investor, then you're probably better off. Well, your best answer would be wait till December all the time, right? But you're probably better off kind of just smoothing it out, because more money will stay in. Let's say you take your distributions for January, you still have February's through December's distribution invested in the market, right? Et cetera, et cetera, et cetera. So if you smooth it out that way, I think that's better for you from an investment perspective, simply because you're removing the vagaries of just short-term volatility, and you're capturing the longer term moments where the markets will, meander forward, if you will, the upward drift, if you will. So you're able to capture it like that. And that's a similar answer to lump sum or contributions. Do I put it all at once or lump sum it? There you would do the lump sum, because the markets go up over the long term, the sooner it's invested, the better. That kind of thing. So here it's the same thinking, but it's the inverse, where I would just fume it out, frankly, myself. Now, that being the case, it does give you a lot more flexibility fuming it out from a retirement income standpoint if you're now doing the bracket management, Wade. And what I mean by that, if you take everything out at the beginning of the year, sure, the money's there, but let's say there's a windfall, you're already touching a bracket, it doesn't give you a lot of flexibility, or it pushes you over something that you didn't want to, because now you can't control it, you already took it out. Whereas if you've been taking out money over the course of the year, and then come October, you realize that, what, if I take out more money here, I'm going to push myself into another bracket because of some other variable that happened that I wasn't expecting. Now you have flexibility to hold off on those, to hold off on those distributions and still maintain the tax efficiency of it. That to me, it gives you a lot more optionality. You're in the market a little longer, over the time period, and I think can help you manage your taxes a lot more as you go along, as opposed to like, it's too late, it's January, you already did this, there's no coming back from this at this point. And don't forget, when you're doing those things, and just to remind you, when we did the stuff on the tax stuff, there's a lot of things that can flip you over the top, the IRMA surcharges, et cetera, et cetera, et cetera. And so you want to make sure that you're giving yourself cushion from an income standpoint. Wade?
Yeah. And so assuming like liquidity is not an issue, or
Yes.
the need for spending and all that, it's right. It's because markets do tend to go up over time, and this is something you're going to be doing every year. The odds are in your favor that in the case of making contributions, make your Roth IRA contributions in January. In the case of taking distributions and I guess we're probably talking more about the RMDs from your tax deferred account, wait till later in the year just to get the most tax advantage growth. I definitely make my Roth IRA contributions in January, start saving up previous year, so that after January 1st, I'm ready to, okay, let's hit these things right at the start of the year. That gives you the best long-term growth prospects. If you're worried about if like the dollar cost averaging resonates with you, there's no big problem with spreading it out more. It's at the end of the day, if markets grow, it might be a little bit less efficient for you, but it's not really going to make that much difference in the long term. The only other caveat, though, on RMDs, we're saying like wait until December to take out your RMDs. There is a problem if you pass away that year. In the year someone passes away, their beneficiaries have to make sure that they take out any required any RMD for that year. So if it's you pass away December 20th and this is a major shock to your family and you haven't taken your RMD yet, if your family doesn't act and get that RMD out by December 31st, there's going to be a penalty involved, not taking out the required amount for the year. So for that reason, you may think about taking out that RMD sooner in the year to give your family sufficient runway to not have this be one more thing to worry about late in the year. But other than that, I would think, yeah, contribute early in the year, distribute later in the year is the way to, over the long term, to get the most tax advantage.
What? So that's different than mine. I would do it just during the year, like slowly. You're saying backloaded. You would personally backload it, which mathematically on an Excel sheet that would work because markets go up. The reason I like to kind of smooth it out myself personally is because it gives me the discipline without thinking about it. I think there's plenty of people that once you give yourself the autonomy to kind of make what you feel are intuitive decisions, like, oh, I think this is going to happen, so I'm going to do it. I think you start running into problems from a behavior standpoint. And so I personally I don't like to do it all at once. I don't like to do it at the end of January, at the end of December either. I just, I would prorate that thing across the year and call it a day. And so I guess technically it's like if I did it in the middle of the summer, a one-time thing in the middle of the summer on average. But I just like to do it throughout simply because it's automated and I don't even think about it. I wouldn't think about it. That would be my game.